Guys, welcome back to some more trader insights here. I want to talk to you today about risk versus reward and how it all correlates to your win rate. This is a topic that every trader needs to master and have as a foundational part of your system and process. This, to me, is really the first concept that you must master and need to understand in order, like even before you place your first trade. So once you fully grasp risk versus reward and how it correlates to your win percentage, you'll be well on your way to a long career in trading. And this is something you'll be taking into consideration on every trade. You're always going to be analyzing your risk versus your potential reward, and you're always going to need to be aware of what your win rate is. Every single trade I take, I'm assessing what is my risk, what is my potential reward, what is my current win rate over the last week, over the last month. So let's define some terms here. Your risk is the amount you're willing to lose on a trade. So whether you're risking $50 or $100, $1,000, that is your risk amount. Your reward is the multiple of that risk. So if you're risking $100 per trade, you want to target trades that are going to give you a multiple of at least 2x or 3x that multiple of $100. So you're risking $100 to get a reward of $200, $300, $400, etc. And your win rate is just simply your win percentage. How often do your trades turn out to be winners? And this is all very easily explained on this chart right here. So you can see on the vertical plane here, we've got our risk versus reward rates. So for example, we've got 1-to-1 here. So here, if you're risking $100, you're targeting a $100 profit. The trade is either going to turn out to be a $100 loss or a $100 profit. And as you can see here, if this is what you're targeting, you need to be winning 60% or more of your trades in order to be profitable. And this is typically where I see a lot of very short-term scalpers. They tend to stay in this 1-to-1 risk versus reward area, but the successful ones tend to have very high win rates, even up to 80 and 90%. There's no right or wrong here. As long as you can stay in this green area and your system, your process allows for you to stay in this green area, there's no right or wrong. Obviously, everybody would love to risk $100 to make $500, but those trades are a little bit more difficult to come by. Still very possible to find those trades, but understand that you're probably going to have a little bit longer time horizon, whereas 1-to-1, you're probably going to be in that short-term scalping, seconds to minutes, for how long your trades are going to be lasting. If you want to get into this area, you're probably going to be a little bit more long-term as a day trader. So we're talking hours and maybe days overnight, etc. So again, there's no right or wrong. You just need to make sure that your system allows and provides a way that you can stay in this green area. So for me, my win rate typically fluctuates between 50 and 60%. Sometimes I dip into the 40s, sometimes I get above 60%. But this keeps me aware of where I'm at and helps me to target the right profitability for what I'm risking. So it helps me in two ways. Number one, it keeps me in my profitable trades longer. So since I'm in between that 50 to 60 range most of the time, I don't want to take profits too soon because that's going to put me in this break even, maybe not profitable range. So I'm always wanting to take my profits at a 2, 3, or 4 to 1 ratio, whatever I'm risking there. So the next thing that it does is allows me to stay disciplined to not let my losing trades go too far against me. If you can always stick to your risk, let's say $100, if you're risking $100 per trade, if you can stick to that and not let your $100 losses get to 150 or 200, then you can make sure that you stay in this green area here. So that's one thing I love about this chart, is that it keeps me disciplined to not let my losers go too far, because I don't want to skew my results over the long term. So let me show you how I determine risk and reward here. So I think in terms of R's. R equals 1 unit of risk. And 1 unit of risk is the amount you're willing to lose on a trade. And I use my account size to determine that. Your max risk per trade should be about 1 to 2% of your account size. So if you've got a $5,000 account, you should be risking no more than $50 per trade. So then whatever stock you're trading, you're going to calculate the price of that stock and account for your account size to get your unit of risk. I'll show you how I do that on a trade here in just a minute. So obviously, the higher your account size, the more risk you can take. But if you've got a $5,000 account, you're probably a new trader. I strongly suggest that you don't risk any more than 1%. This might not be a popular opinion because new traders get into the markets and they want to go all in, thinking that they're going to get rich in a day or two, and they risk too much of their account size per trade. And think about it, if you're risking 10% of your account size, so that's $500 per trade. And if your win rate is right around 50 or 60%, there's going to be a time where you're probably going to lose 3, 4, 5 trades in a row. And that's going to be devastating to your account. If you're losing $500 per trade on a $5,000 account and you lose 5 trades in a row, well, half your account is gone just like that. So a proper risk size is essential for longevity in the game. So it's not about getting rich in a day or two. It's about keeping yourself in the game long enough to give yourself the opportunity to get rich. So R's are 1 unit of risk. R also refers to the profit that a trader makes on a particular trade. So for example, a 2R trade means you made 2 times your risk on that trade. If you're risking $100 and you have a 2R trade, that means you made $200. A 3.5R trade means you made $350. A negative 1R trade means you lost 1 unit of risk. You lost $100 on that trade. So if you can keep your winners positive, 2Rs, 3Rs, 4Rs, etc., and keep your losers at just -1 and not let them go to -2, -3, then you're going to stay in the green as much as possible and give yourself the best chance. The whole goal of trading is to have 1R losses and 2+R wins. So let's show you a real world example I'm going to show you this chart, SNTI, that we traded a couple weeks ago. And let's just say for this example that we have a $5,000 account. And let's just kind of dive in here and show you how I would determine how many shares to take, what our unit of risk is going to be, and how we're going to manage that trade in order to get us in the green there. So on this particular stock here, we identified this level of resistance here, right over the 770s. And as you saw, we took our entry right around the 780. So this is probably the ideal entry if you could have got it. You know, this happened really quickly on the day that it happened. So TradingView has this really nice tool that you can use to put yourself in okay, so you can pull up this tool on TradingView and set it right at your entry. So we had determined that 780 level was going to be our entry. The first thing we do after that is determine where we're going to stop out if we're wrong. So there's a couple places here. The most obvious to me is this breakout candle here. The low of this breakout candle is right around 720. That to me probably makes about the most sense as an area to set our stop loss if we ended up being wrong. Yes, you can set your stop in the mid sixes here, but I think that's a little too far away. And if this is going to be a breakout that goes in our direction, we don't want to see another candle break the low of this breakout candle. It's not going to be as powerful. So I think it's reasonable to set our stop right around the 720s. So we're risking about 60 cents per share here. So if we've got a $5,000 account and we want our unit of risk to be about $50, we just take our stop loss, which was 60 cents, and times that by 80 shares. That gives us a max loss of $48 there. That's close enough to $50. So in this particular example, with a $5,000 account, we would enter our position with 80 shares and buy 80 shares at right around 780, set our stop loss at 720. If it turned out to be a losing trade, we would lose no more than $50 or 1R. It would be a 1R loss of $50. So then what do we do for our targets as we're targeting a profit of greater than 2 to 1? So the one thing I like about this tool is it shows your risk versus reward ratio right on the tool itself. So if we set our risk reward ratio right at right around 2, you will see that price needs to get up just over $9 in order to reach that 2 to 1 risk versus reward ratio. So in this case, we would start to think about taking profits at right around the $9.15 area. So if we started selling some of our position, so we've got 80 shares, what I like to do is sell about half at this first target of 2 to 1. So we sell 40 shares at $9.15. The very next thing we do after we sell some of our position is move our stop loss up to break even. Okay. Now this does one very important thing. It allows us to walk away with a profit no matter what happens from there. If price drops back down and we get stopped out on those last 40 shares, we're at least going to walk away with some profits. Now it's basically just a free trade. And as price starts to move higher, we're going to start scaling out of the rest of that 40 share position that we have. We've sold 40 down in 9.15. We're going to probably sell 20 up in the 11s and 12s and sell the last as we're looking for reasons to exit our trade. So once we've sold half of the position, we start to look for reasons to exit on the rest. And one of the main reasons I look to exit is I look for the first candle to break the low of the previous candle. You can see that's this one right here. All of these candles after the breakout are higher candles than the previous candle. None of these candles here are breaking the lows of the previous candle until you get all the way up to here, right in the 14s. Now, as it turned out, this stock actually went through a halt, a volatility halt. So whenever a stock is going up more than 10% in a 5-minute period, NASDAQ will halt the stock and just let everybody cool down and before they open it up again. So that's just a kind of a way of protecting investors. So when you start dealing with halt conditions, it's helpful to know where a stock is going to halt and maybe sell some ahead of that. But if you weren't able to do that, then I always like to start selling immediately after it opens up, because you never know what's going to happen once you get into halt situations. It was halted at the 1280s. This thing could have opened at 8. It could have opened at 14. The thing with halts is you really just don't know. It becomes a big question mark. So selling another 20 shares in this area makes sense, and then hold on to that last 20 until the first candle to break the low of the previous candle, or until we get a candle that breaks below the 9 EMA. So how did we do on this trade? So we made a 2-to-1 profit on our first 50% of the position. We made 2 R's on 50%. We made, let's bring this back to where our stop was originally. So, okay, so we made 2 R's on half of the position. We made 7 R's on a quarter of the position, and we made about 10 R's on the last quarter of the position. So all in all, this trade could have easily turned out to be a 4 or 5 R trade. And that's how we analyze our performance. We would write this down in our trade log and journal saying, okay, this was a 4 or 5 R trade, and we would use it to analyze our trading performance over time. So let's look at another example here of a short trade on MicroStrategy. This is one I found myself trading a lot recently. It's a Bitcoin name. So a couple of days ago, we had a really good setup here. It's a little bit higher price stock. So if you've got a $5,000 account, you're probably not going to be trading this stock since you can only take like 10 shares. But this is probably something for somebody who's got a $20,000, $30,000, $40,000 account or more. Now, as we take a look at this trade here, we've got a support area right at the 397s. Now, for this example, let's say we've got, I don't know, like a $20,000 account. And we're looking to short this under this support area. You can see we tagged the 397s 1, 2, 3, 4 times. And if we break under that, we're going to take a position short. So we just pull up our short position tool here, set it right at our entry, 397, and then we look to set our stop. So if we got a $20,000 account, how many shares are we going to take? Well, first we set our stop. Now I think we've got this breakout candle here, so it's reasonable to think that if price got bought up back above that breakdown candle, it's reasonable to think that it's probably not going to go in our direction. So I think if we set our stop right around the 399 area, that's basically $2 of risk right there. So we've got a $20,000 account. How many shares can we take? Our max loss is going to be 1% of the account, which is $200. So, and we've got $200 of risk. That's going to allow us to take 100 shares. If we enter the position short with 100 shares and we take a $2 loss, that will get us our max loss of $200. So 1R equals $200 on a $20,000 account. So we've taken our entry at 397. We've gone short with 100 shares. How do we manage the trade from there? We've got our stop loss at 399. We need to take profits on half of that position right at 2-to-1. So if I could, this tool can be a little bit finicky. There we go, 2-to-1. Where does that take us? That takes us to the 393 areas, 393.50. That's right here. So our entry is 397. With 100 shares, we cover 50 of those shares at 393. Then we move our stop loss down to break even. So now it's impossible to lose on this trade. No matter what happens from here, we're going to walk away with a winning trade. It might not be our 2-to-1 winner that we wanted to get, but at least we're going to walk away with some profits. Then we look for reasons to exit on the rest of the trade. And in this case here, we get our first candle to break the high of the previous candle. That's this one right here. So we might cover another 25 shares at in the 391s, and then let the rest ride. So as you can see here, price tries to break over the 9 EMA, gets sold off even more. Then we pop back up, and the bounce is a little bit weaker than this one here. This bounce here, also a little weaker. So we could move our stop loss down even further on that last quarter, down to 393, now 394, and guarantee ourselves a winning outcome on that last quarter, and just let it ride. Hopefully we get a nice move lower down into the 380s, but as it turns out, we got that move. We dipped down into the 386 area, and then we got bought up over the 9 EMA again. So probably taking off that last quarter in the 380s is probably the best thing to do at that point. So what did this trade turn out to be? We had our stop at 399. We got our 2-to-1 target on the initial 50%. We got a little bit more on a quarter of it, and we got maybe into the 3R range on the last quarter. So this trade ended up being about 2.3, 2.5 R trade. And that's really just how we manage our positions in light of our risk versus reward. And then we log this trade as a 2.5 R trade into our trading planner, and we use it to analyze our trades. So hopefully you found this video helpful, and as homework, just go back through the last maybe 10 to 20 best opportunities over the last couple of months. Plot this little tool on there and Try to find where the best entries are, where you would set your stop losses, what size you would take based on what your account size is, and look for that 2 to 3, maybe 4 or 5 risk versus reward profit targets, and use it to hone your system and get yourself in the green. So thanks for joining me. And as always, if you found this video helpful, click the subscribe, the like, share, and hopefully we'll see you on the next video.